All right, let's talk about Brandywine Realty Trust, ticker BDN. After what has been, let's be honest, a brutal year for office real estate, they just dropped their Q4 2025 earnings. And whoa, did they deliver a surprise? The stock just took off. So what exactly happened? Let's dive in. So here's the million-dollar question we all have to ask ourselves. Was this just a relief rally? You know, a classic dead cat bounce where even a falling stock will bounce a little before it keeps dropping? Or is this the real deal, the beginning of an actual recovery for one of the most beaten down sectors out there? The market's reaction was, explosive for sure. But let's not forget the fundamental problems for office space. Yeah, they haven't just vanished overnight. Okay, so first things first, let's break down the surprise earnings beat that really lit the views on this whole rally. And here are the numbers. Look at this. It's a clean double beat. The GAAP EPS came in at a loss of 21 cents, but hey, the street was expecting a loss of 23 cents. So that's a nice 2-cent beat. And then you look at revenue, almost $121 million against a consensus of about 116.5. That's a beat of more than $4 million bucks. You know, in a sector this challenged, any upside surprise gets attention. This was a big one. And how did the market react? Well, it was immediate. The stock absolutely ripped higher, surging over 13% in a single day. And it wasn't on light volume either. This tells you everything you need to know about just how starved investors were for any piece of good news in the office space. But look, the headline numbers, that was only part of the story. The real driver here, the thing that really got investors excited, was management's new playbook for 2026. This is where the earnings call got really interesting. So management laid out this pretty clear, three-pronged plan to get their financial house in order. Step 1, asset sales. They're targeting $280 to $300 million in dispositions. Step 2, debt reduction. They're going to take the vast majority of that cash and just pay down debt. And step 3, JV recapitalizations, which is basically reshaping the ownership of their big Austin projects. Now, think about it. In the high-rate world we live in, a real estate company aggressively cutting its debt, that is absolutely crucial. It means lower interest costs, and it sends a powerful signal to the market that they are serious about fixing the balance sheet. And, you know, the CEO, Jerry Sweeney, he couldn't have been clearer. He said, and I'm quoting here, "The vast majority of sale proceeds will be used to reduce debt." He's basically spelling it out for everyone. The number one priority is deleveraging. And for a company where the balance sheet has been a huge question mark for investors, man, that was exactly the message everyone needed to hear. And the guidance they gave for 2026 really backs all this up. They're guiding to strong FFO, that's funds from operations, a really key metric for REITs, somewhere between 51 and 59 cents per share. They also see occupancy improving and, get this, positive net absorption for the first time in years. That means they expect more space to be leased than vacated. On top of that, their core portfolio is now 100% unencumbered, no mortgages on those key properties, and they've still got a $600 million credit line completely untouched. The whole liquidity picture just looks so much better. Okay, but let's pump the brakes a little bit. A plan is just a plan until you actually do it, right? Now we've got to talk about the hurdles, the risks, what I like to call the execution gauntlet. This is really a tale of two cities for Brandywine. On one hand, you have their Philadelphia portfolio, which is just crushing it. We're talking 95% occupied, 97% leased, and capturing over half the new leasing in the entire market last year. But then there's Austin. Oof. It's only 74% occupied, and that single market is dragging down the entire company's occupancy by 4 full percentage points. Fixing Austin isn't just important, it's everything. Now, it's not all bad news on the operations front. There are some definite bright spots. Their same-store net operating income grew 2.4%. Now, what that tells us is that if you just look at their existing stabilized properties, the core of the business is actually still growing. The underlying assets have some real strength. But, and this is a huge but, let's not get carried away. Despite that awesome one-day pop, you have to zoom out. Over the last year, the stock is still down more than 40%. This number right here is a brutal reality check. It shows you the massive hole they are still trying to climb out of. And it's why executing on this new plan, it isn't just important. For them, it's basically existential. So, what are the big risks we need to keep our eyes on? Well, first, those asset sales. Can they really sell $300 million worth of buildings in this environment and at good prices? Second,
Refinancing. They've got a big $178 million construction loan due in July of 2026. That's a big hurdle. Then, of course, there's just plain old leasing. Can they fill up those key development projects in Philly and Austin? The answers to these questions are going to dictate where the stock goes from here.
So, putting it all together, what's our take here at Talk Tickers? What's the bottom line? We're assigning a rating of market perform, and here's why. On one hand, management has laid out a credible, aggressive plan that focuses on exactly the right things, fixing the balance sheet and shoring up liquidity. We love that. But on the other hand, the risk of actually pulling it off is incredibly high, and that Austin portfolio is still a massive anchor. So we think the plan puts a floor under the stock, but the path to actually outperforming the market from here, it's going to be a narrow and very bumpy road. All right, so with that in mind, if you're looking for a potential way to play this very complex situation, we've got a trade idea that kind of reflects our cautiously optimistic, but still very risk-aware view. The idea here is to sell cash-secured puts. Okay, so what in the world does that mean? It's actually pretty simple. You're basically getting paid today for agreeing to buy the stock at a lower price in the future. So for example, you could sell a put with a strike price of, say, $2.50. If the stock price stays above $2.50, you just keep the cash premium you collected up front. Free money, basically. But if the stock does fall below that and you get assigned the shares, well, now you own the stock, but your actual cost basis is that $2.50 strike price minus the premium you already got paid. So you're getting into the stock at a deep discount to even today's price. It's a great way to either get paid to wait for a better price or to define exactly where you'd be a happy buyer. And of course, just a reminder, this is not financial advice. Please always do your own research.